Hi, in this chapter, I'm going to talk to you about investment criteria, specifically net present value and the internal rate of return, also known in finance as NPV and IRR. Now, investment decisions are made using a variety of criteria in practice, but a good criterion should have at least three attributes. One, it should use cash flows, not accounting profits. The reason for this is very simple. Accounting profits can be manipulated, and accounting profits can be timed, but not so with cash flows. Use cash flows over the entire life of the investment, not part of the life. For example, there are some criteria, such as payback, which use cash flows over a limited period of time. So, how does this actually work? So, you may be thinking of investing $1,000 and you say, how soon will I get back this $1,000? Well, it's quite possible that you get back this $1,000 in 2 years, and then you think that it is a great opportunity, but maybe 3 or 4 years down the line, you have a big cash outflow waiting for you, and the project may not be so great after all. Example of this could be mining projects where you get a lot of money up front, but you still have to spend money at the end to close the mine. So consider the entire life, not just a part of the life. And the third important attribute that good investment criteria should have is that these cash flows should be adjusted for time value of money. So criteria which do not adjust for time value of money are conceptually unsound because they mix apples and oranges. The commonly used criteria in practice are payback period, accounting rate of return, internal rate of return, net present value, and the profitability index. We have discussed these criteria at length in the textbook that is prescribed at the end of this presentation. But what I wish to emphasize here is that net present value and IRR are the two best criteria for making investment decisions. So NPV is better than IRR because IRR has certain problems which arise in certain special types of cash flows. But without going into this in this overview, what I wish to say is that NPV is a better criterion than IRR. Use both, but if in confusion, follow the NPV. PI, or the profitability index, is appropriate in selecting from among a set of positive NPV projects with different levels of initial investment. So if you had three projects, all of them have positive net present value, then all of them are financially good projects. But if you had to rank from among these three and choose only one, then PI is appropriate because it links the NPV to the size of the initial investment. So what is the big picture? Net present value is expressed in dollars or in some other currency, but IRR is expressed as a percentage. Now, this is important for you to distinguish. So, NPV is in money terms and IRR is in percentage terms. Using NPV, investments are accepted if the NPV is positive. Technically, investments are good even if the NPV equals zero. But if the net present value is less than zero, then it's not a good project. Likewise, IRR is accepted. Projects with IRR greater than the cost of capital are acceptable. That means IRR as a percentage should be higher than cost of capital, which is also expressed in percentage. But remember that if NPV and IRR lead to different decisions, please follow the NPV. In the next chapter, we will talk about how to compute NPV and IRR.